Hey everyone, welcome back to the channel. Today we're diving into a topic that affects every single one of us. Whether you're a seasoned investor or just trying to make sense of your savings account. We're talking about the Federal Reserve, or the Fed, and its immense power over the financial markets. Think of the Fed as the Wizard of Oz of the economy, pulling levers behind the curtain that can make markets boom or bust. But how exactly do they do it? And more importantly, what does it mean for you? Stick around, because we're about to demystify it all. First up, let's talk about the Fed's main weapon, interest rates. You've probably heard the term Fed funds rate. This is the interest rate at which banks lend money to each other overnight. It's the foundation for almost every other interest rate in the economy. When the Fed wants to stimulate the economy, it lowers this rate. This makes it cheaper for banks to borrow, and they pass those savings on to us in the form of lower interest rates on mortgages, car loans, and credit cards. Cheaper borrowing encourages people and businesses to spend and invest, which boosts economic activity and often sends the stock market soaring. On the flip side, what happens when the economy gets too hot and inflation starts to rise? The Fed steps in and raises interest rates. Borrowing becomes more expensive. That new car loan or mortgage suddenly looks less affordable. Businesses might postpone expansion plans. This slowdown in spending helps to cool down the economy and bring inflation under control. For the markets, higher rates can be a buzzkill. When safe investments like government bonds start paying more interest, investors might pull money out of riskier assets like stocks, causing market downturns. It's a delicate balancing act, and the Fed is walking a tightrope. But interest rates are just one tool in their toolkit. Let's talk about another powerful mechanism, quantitative easing, or QE. It sounds complicated, but the concept is pretty simple. During times of crisis, like the 2008 financial meltdown or the 2020 pandemic, the Fed essentially creates new money out of thin air and uses it to buy massive amounts of government bonds and other financial assets from banks. This floods the financial system with cash, pushing long-term interest rates down even further and encouraging lending and investment. Think of it as injecting a huge shot of adrenaline directly into the heart of the economy. QE has been a major driver of the bull markets we've seen over the past decade, lifting asset prices across the board from stocks to real estate. Of course, what goes up must come down. The opposite of QE is called quantitative tightening, or QT. This is when the Fed starts to shrink its massive portfolio of assets. Instead of buying bonds, it lets them mature without reinvesting the proceeds, or even actively sells them. This process pulls money out of the financial system, which tends to raise interest rates and can act as a brake on the economy and the markets. We're actually seeing this play out right now, and it's one of the big reasons for the market volatility we've experienced recently. The transition from an era of easy money with QE to a period of tightening with QT is a huge shift, and the markets are still adjusting to this new reality. So the Fed has these powerful tools, interest rates, QE, and QT. But there's another, perhaps even more powerful, tool at its disposal. Its words. This is often called forward guidance. The Fed chairman and other officials regularly give speeches, press conferences, and testimonies. What they say, and even how they say it, is scrutinized by investors around the world. By signaling their future intentions, whether they plan to raise, lower, or hold rates steady, The Fed can influence market behavior without actually doing anything. If the Fed chairman hints that they're concerned about inflation and might raise rates sooner than expected, markets can sell off in an instant. If they sound optimistic about the economy and suggest rates will stay low, it can spark a rally. Their words have the power to shape expectations, and in financial markets, expectations are everything. This incredible influence has led to a common saying on Wall Street: "Don't fight the Fed." It means that when the Fed is pumping money into the system and keeping rates low, it's generally a good time to be invested in assets like stocks. Conversely, when the Fed is tightening its policy and pulling money out, it's a time for caution. For decades, this has been a pretty reliable rule of thumb for investors. When the Fed is on your side, the wind is at your back. When it's not, you're sailing into a headwind. But this raises a critical question. Is this much control a good thing? On one hand, the Fed's actions have helped prevent deeper recessions and stabilize the economy during major crises. They provided crucial support when the system was on the brink of collapse. Without their interventions, the economic fallout from 2008 and 2020 could have been far, far worse. They act as a vital backstop for the entire financial system. On the other hand, some critics argue that the Fed's constant intervention has created a dependency where markets can't function without the promise of easy money. This can lead to asset bubbles, where prices get inflated beyond their fundamental value simply because there's so much cheap money chasing returns. We saw this with the dot-com bubble and the housing bubble, and some argue we've seen it again in recent years in everything from stocks to cryptocurrencies. When these bubbles eventually pop, the consequences can be painful for everyday investors who get caught in the fallout. Furthermore, there's the issue of wealth inequality. The Fed's policies, particularly QE, tend to benefit asset owners the most. When the stock market and real estate prices go up, those who already own those assets get richer. Meanwhile, savers who rely on interest from their bank accounts have been earning next to nothing for years. This has contributed to a widening gap between the wealthy and the rest of the population, which is a major social and economic challenge. So what does all of this mean for you, the individual investor or saver? First, it is crucial to understand that the Fed is one of the biggest factors driving the markets. Paying attention to what the Fed is doing and saying can give you a better sense of the overall economic environment. Are we in a period of easing or tightening? This context is key to making informed financial decisions. Second, remember the mantra, don't fight the Fed, but also be aware of the risks. While it's great to ride the wave when the Fed is accommodative, it's also important to be prepared for when the tide turns. This is why diversification is so important. Spreading your investments across different asset classes can help cushion the blow when one part of the market is hit by a change in Fed policy. Ultimately, the Federal Reserve wields an incredible amount of power. Its decisions ripple through every corner of the global economy, influencing everything from the price of your groceries to the value of your retirement account. By understanding how the Fed operates through interest rates, quantitative easing, and forward guidance, you can become a smarter, more informed participant in the economy. It's not about trying to outsmart the market or predict the Fed's next move, but about understanding the forces at play so you can navigate the financial world with more confidence. Thanks so much for watching. I hope this breakdown was helpful. If you found value in this video, please hit that like button and be sure to subscribe for more content that helps you make sense of the world of finance. Let me know in the comments what you think about the Fed's role in the markets. Is it too powerful? Is it a necessary evil? I'd love to hear your thoughts. Until next time.